Okay, so this is the World Bank mini course, and it's the shortest forex course in the world. And this is the course outline for what we are going to be discussing. All right, let's move forward. So without wasting much time, what is forex? Forex is that type of financial market that deals with the exchange of one currency from one form into another. All right, we may be exchanging one currency from say GBP, which it was, to let's say the euro. Okay, what is the aim of changing this currency from one form to another is to make profit, as with any other business. I don't know if you understand. So now we exchange this currency with the aim of buying low and selling high. Buying low and selling high. You know, if you have a bread business, for example, you cannot bake bread and you want to and the cost of baking bread was like 50 naira and you sell below 50 naira because 50 naira will be your cost price. You have to sell above 50 naira so that you can make profit. Understand? So in the forex market, if you buy a particular currency at say as a scenario that I like using as an example. In 2015, $1 was around 140 naira, but today $1 is around 360 naira. So what if you had bought when it was cheap, when you had bought low, and then as of this time when $1 has increased in value, you are now trying to sell. You don't understand? That would mean that you are making profit. You understand? So now forex is a $5.4 trillion a day market, which makes it the largest financial market in the world. It's larger than stocks, it's larger than bonds, it's larger than treasury bills, it's larger than any other financial market that you know of. Alright? Because what it does in a day, it's what those financial markets do in say 3 months, 4 months. You understand? So profit is made from price volatility. Price volatility simply means price movement, change in price, alright, over a given period of time. So that's what price volatility means. So now, what moves the market? There is this sentiment that is those things that are happening in an economy that solely moves the market. But here at the World Bank, that's not what we believe. We believe that traders' sentiments to fundamentals and other factors such as price action and where price is are the factors that moves a market. All right, those are the factors that move the market. So when we talk about what moves the market, we are talking about not just the fundamentals, not just those happenings in the economy. Maybe there's an earthquake that can affect. I'm not doubting that fact, but other factors such as where price is it a level that has been previously retested and all of that also determines how the market is going to move. So now, characteristics of a successful trader. So before someone will say, okay, you are successful in a particular business, there must be certain characteristics. There are those things that you do differently that makes you successful. All right. Forex is one business that requires discipline. If there's anything that requires discipline, it's forex trading because you need to be very, very disciplined. You have to be very, very disciplined to stick to your trading plan. All right. What is your trading plan? Just like you have a business plan, you have a plan that you want to carry out. You understand in terms of business, and you have laid out this plan that would eventually lead to your success. You have to stick to that plan no matter what is happening, no matter if the things you are not seeing result. I don't know if you understand. You're not seeing result. You have to stick to that plan until you get to the end of the plan. You understand? Forex is about effectively execution of a plan. The plan, I will state out the plan for your forex trading before the end of this course. I'll show you how the strategy is done and everything, how you can be profitable, how you can be making money. You understand, in the forex market. Now it is your duty to stick to that plan. You understand? Unemotionally. So what do I mean by sticking to the plan unemotionally? It means you don't have to attach emotion. We have what is called losing streak. There are sometimes you might have streaks of losses because nothing is perfect. All right, this business is not something that you would always expect to have it well. But I can show you before the end of this course. I will show you how you can always make profit in the forex market every month. It's not that you're going to win all your trades. Anybody that tells you you're going to be winning all your trades is lying to you because it's not possible and it will never be possible. But I can tell you how you can win most of your trades, and then how, even though you are not winning most of your trades, you can still be profitable. That's having an edge over the market. All right. So now you have to be result oriented. What I mean by, sorry, before that, you have to be knowledgeable. Have a mentor. Like now, you have signed up for World Bank course, and then you are now your mentor. I'm teaching you how to trade forex, and this is the right way to go about it. Most people want to skip this process. You understand? That's why they tend to lose a lot of money in the forex market and tend to tell people that forex is a scam and all of that. It's because they don't want to go about it the right way. You cannot become a doctor, you cannot become a lawyer without passing through the university, right? Then how come many people want to become a successful forex trader without passing through maybe a mentor or without passing through someone who has done it? That's obviously a mentor. I don't know if you understand who is successful. You have to follow someone. You have to follow in the footstep of a particular person, all right, that you like his result, that you like his style of trading. Okay, so we have result oriented and knowing trading is a performance act. All right, what does that mean? It means that trading, as such as football, such as running, it's an act that you get better with practice. So you have to be result oriented. You have to know exactly what you want. All right, your objectives, your goals have to be straight. You understand? So now let's talk about the objective. Your objective in the forex market is not to make money. All right, it's to make profit at the end of the day. That's quite alright because all business is to maximize profit, but it's not to make money. If you focus on the money too much, you tend to lose money. That's the idea. So what you should do rather is to make the best trade. How can you effectively execute your plan? How can you be disciplined enough to stick to your trading plan? How can you be unemotional about your trading plan? How can you be, all of that? So if your objective is to make the best trade, you might make the best trade. That's following the best trade is made when you follow 100% of your strategy plan. You understand? Your strategy say when there is 1, 2, 3, you should buy at 1, 2, 3. Don't know you understand. That's what forex trading is all about. So far as you have a strategy that has an edge, all right, over the market, you will come out successful. So far as you don't deviate from your strategy. So now you have to have a good risk reward ratio. People don't understand what it means to have a good risk reward ratio. Some people are risking more than they are gaining. Let's say at any time you are losing 2 naira. You understand? And then when you are winning 1 naira, and then you have 10 opportunities. You understand? If you are losing, and then let's say you have 10 naira, you are losing two naira. Just 5 losses, you will blow your account, and the wins are not even strong enough to cover you. But if you have a good risk reward ratio like 1:2, that means you are risking one. That's you are risking 1 naira. Anytime you win, you are winning 2 naira. Because it is a fact. I say it again. It is a fact that you cannot lose all the trades. Even though you are closing your eye to place trade randomly, you cannot lose all the time. You understand? You cannot lose all the time, and then you cannot win all the time. So those times that you will win, if you have a good risk reward ratio, you can maximize that win. You understand? So now, if you are losing 1%. That's you are cutting your losses short. You are losing 1%, 1%, 1%. And you have 6 losses. That's 6 naira is gone. But each time you are winning +2. That's risk reward ratio of 1:2. You are winning +2, +2, +2, +2. That 4 time that you won is good enough. You see that you are losing more than you are even winning. But that 4 time that you won, because you are gaining +2, +2, +2, you find out that you will make that's 2 times 4. Sorry, yes, no, that will be like, because we have two for each of those four naira that you have. That will be a cumulative of about 12. All right, do the math. It's about 12. Each time you are winning in those 4 times that you were successful, you are winning +2 naira. All right, and the time you were unsuccessful, you were losing only 1 naira. You had 6 unsuccessful trades. By the time you were winning, you have +2, +2, +2, +2 into 4 places. Those 4 times. Understand? You discover that you came out with, you made back all those your losses, because you end up with 12. 12 means that you have made back all your losses, and then you even came out with 20% return on investment, which is very, very good. So a forex trader doesn't have to be greedy. He has to risk less. You understand? He has to risk less. He doesn't have to be greedy. He doesn't want to make all the whole money today. That's the whole $5.4 trillion in the forex market. He doesn't want that supposed to be. I want to make all that money within a day, because that's the fastest way to lose money. He's someone that is patient. He's someone that is waiting for trades to come to him. He's trying to execute the best orders possible. So let's talk about characteristics of an unsuccessful forex trader. He's not disciplined. Doesn't stick to his trading plan. He's very emotional. Maybe he has 2 losses, 3 losses in a row. He doesn't take the fourth trade, thinking that the fourth one too would be a loss. I don't even understand. That you don't know that at the fourth time that might be when you will be successful, and then you have lost out in that opportunity. So he's not emotional. what he's doing, so far as you have a good strategy like what World Bank is going to teach you, you would never have to worry about making money again for the rest of your life because you will always make money. You don't even understand. So now you don't have to be emotional. The fact that you're having two trades doesn't mean that your strategy is not working again. It only means that it's going through what is called losing streak. And before the end of the day, before the end of the week, before the end of the month, you find out that your winning streak is going to come. And when that winning streak comes, because you have a good risk reward ratio, you're going to maximize the wins, and then the losses you're going to cut them short. Therefore, you're going to come out with profit at the end of the day. So now you don't have to be you have to be knowledgeable. But if an unsuccessful forex trader is not knowledgeable, it's someone that just comes into the market and pick up one or two random information from YouTube and feels he can be profitable doing that. It's not possible. You have to properly learn how to trade forex. You don't have to come with that gambler's mentality. I'll come today with $100 and make $1 million. It's not possible. It will never happen. So now, your objective, most people have this wrong objective that they want to win on the trade, they want to be flawless. You understand? It's not possible. You rather would want to make the best trades following your strategy, following your trading plan, not to win all the trade. It's not possible to win all the trade. So far as you have a good risk reward ratio, which gives you an edge over the market, you will certainly come out profitable. And with the strategy we have here in World Bank that we are going to back test alongside with you, you see that the strategy has proven to have an edge over the market. That means every single month it has been coming out with profit for the past 10 years. All right, that gives us a higher probability that in the future it's going to still do well, and it continually does well for me. So now your objective is not to win all trades, but to win the most that you can, and then and to take the best trades. So you have to have a good risk reward ratio. You should not be losing. You should not be risking more than you are winning. I don't know if you understand. You should be rather be you should risk small and win more. You understand? So that when the losing streak comes, you don't burn yourself. You don't tend to lose a very very large amount or a larger portion of your trading balance. So now you should not be greedy. Rather you should you should you should you should rather be realistic. All right, it's not something that you put $100 and make $1 million. You should not be greedy. So now let's talk about the fundamentals. Let's talk about the fundamentals. Now we can understand the fundamentals as a car, and then we have a driver. Okay, we can understand the fundamental as a car, and then we have a driver. Now this is the key to this illustration that we have here. The driver now is the CBN governor. All right, then the brakes, that's the brakes that is applying, is the interest rate. Then the fuel that is enabling this car to move is productivity. Then the speed of this car is economic growth. So for an economy to grow, for the financial asset of an economy to be increase, that's to go up, what needs to happen? The driver has to has to apply his brakes, which is interest rate, and there has to be fuel, there has to be productivity in order that will lead to speed, that will lead to economic growth in this economy. I don't know if you understand. So now, how does this work? The CBN governor, if the economy of a particular country is perceived by the CBN governor to be very very slow, because he's the regulator of this economy, all he just needs to do is to increase interest rate. That if he perceives that an economy is too slow and he wants to facilitate that economy, what will he do? He will rather increase interest rate. Okay, when he increase interest rate, people would, it's the opposite. He will reduce interest rate. That will now discourage people from saving money in the bank. They will now take money and now invest in other forms of productive activities in order to make more profit. If the interest rate was favorable, there will be no need to produce. All right, and productivity, it's directly proportional to economic growth. If there's no production, if there's no productivity in a particular economy in Nigeria, that's why Nigeria is suffering what we are suffering to, because there's no productivity. Rather, we tend to want to import every single thing that we have in Nigeria, from rice, from agricultural and agricultural product, and everything we want to import. That's why there's no productivity in Nigeria. That's why the economy of Nigeria is at where it is today. So for an economy to strive, for an economy to grow, what needs to happen? The CBN governor has to has to reduce interest rates. What that will mean is that investors, they will take out their money from the bank and then put in the economy, which will increase productivity in that economy, which will now lead to economic growth. Now, if the CBN governor increases economic growth, because the aim of every economy is not to be too fast and is not to be too slow, rather is to be stable. Because if your economy is too fast, it will lead to a spontaneous increase. When I mean spontaneous, I mean rapid increase, up to the extent that people would not be able to possess your financial assets because it will be too high. Imagine that $1 is like 3,000 naira. Would you have the ability, will you have the determination to want to buy the dollar? It will be too costly because the economy of the US is too good. So that's not how, there's no perfection in this world. It has to be stable. There's rather stability. So for that stability to be maintained, when the CBN governor perceives that the economy of a particular country it's growing spontaneously, which is due to productivity too much in that economy, what was it do? It tends to want to seduce investors so that they will take back their money to the bank by increasing interest rate. Have you seen the connection? When you increase interest rate, that means when you put your money in the bank, you will get more interest for keeping your money in the bank, for saving your money in the bank. So when you do that, it now takes out money, which is a major fuel for productivity out of that economy. When it takes out money from that economy and then people are now rather saving that money in the bank, what happens? The economy slows down. So it is this facilitation or it is this speed and slowing of economy that causes that causes what is called volatility in the forex market, and that's what we trade. It is this movement that is caused by the CBN governor either increasing interest rate or reducing interest rate, or you know, which will in turn affect productivity, which will in turn affect economic growth. I don't know if you understand.
Yes.
So if the CBN governor, for example, if I'm to ask you a question, that if the, what would the CBN governor do when he notice, because the aim of every economy is not to be too fast, is not to be too slow. I don't know if you understand. It's rather to be what?
Please come again. Come again.
The aim of every economy is not to be too fast, is not to be too slow. It's rather to be what? It's rather to be stable. Alright? Because if it is too fast, if it's growing at a spontaneous rate, imagine a scenario where $1 is about 1,000 naira. That's too costly. It will be too costly for people to want to do business in that kind of country. Don't even understand. So it's rather to be stable. It should be just in a medium value. It should be like $1 should be like 360. It's not that the difference is not that much. It's bearable. Don't even understand. Not so high that people cannot afford. And then it doesn't have to be too low. You understand? It should not be valueless. Your economy should not be an economy that the world can do without because there's no productivity in that economy. People follow productivity. Money chases productivity. If you are not productive, there's no how you can make money. And that's how it is with an economy. If the economy is not productive, there's no how that economy can grow. So what I'm trying to say is that if the CBN governor perceives that the economy, because he wants to stabilize the economy, is the regulator of this economy, because he wants to stabilize the economy, if he perceives that the economy is growing at an exponential rate, which is too fast, and he knows the end result of an economy growing too fast, I don't know if you understand. He knows that it will lead to the price of the financial assets of that particular economy to be too costly for other investors to do business with, as in the example I just gave.
Yeah.
What he would rather do is to slow down that. So how does he do that? What he does is that he increases interest rate because he knows the source of what is causing that increase, that speed in economic growth, which is productivity. And what fuels productivity is money. So he knows that there's too much money in this economy. That's why this economic growth is moving at that spontaneous rate. So what will he do? He wants to suck out that money from that economy. And how does he achieve this? He tends to seduce them. He tends to deceive them. He tends to make them to bring their money to the bank so that it will be a fair deal. When you bring your money to the bank, he will say before it was 5% a month. Now he has increased it to 10% a month. Many people will start, instead of me suffering to do production, to do this and do that, let me take my money to the bank where I can get 10%. After all, if I do my production, it's still 10% a month I will make as profit. Rather, it's not better that my money sits in the bank and I still make that same 10%.
Mm.
That's what people will do. So when the people start removing money from that economy, productivity reduces because money is what fuels productivity. Therefore, therefore the economy is going to slow down. You see how the civilian governor has been able to reduce
Mm.
productivity, has been able to reduce economic growth because the economy doesn't have to grow too fast.
Mm.
Rather, it has to be stable. When you see that the thing is moving too slow, what does he do? What he rather does is that he reduces interest rate. I mean, people that were having at 10%, he reduces it to 5%. They'll say,
Yeah.
after all, I can have it better now if I'm doing one business there. If I have a cement factory, I can be making 20%. Why is the government reducing interest rate to 5%? I don't know if you understand.
Yes.
What they'll simply do is they take out their money from the bank and now start investing in those ventures that they see as being profitable. Don't you understand? So doing that will now lead to what is called economic growth. So you see how the CBN governor, who is the regulator of that economy, is able to regulate how fast the economy is going and how slow the economy is going. That's the volatility of that particular currency. When I say economy, I mean currency. When I say economy of Nigeria, I'm talking about the naira because we are talking about the forex market. That's the finance. That's the forex market. I don't even understand.
Yeah.
So when I say that economy, I'm talking about the financial asset of that economy because when an economy is doing well, the financial asset of that economy is going to do well. If Nigerian economy is doing bad, you see as our financial, our naira is so valueless. You cannot use naira to buy anything these days. I don't even understand. So that is what it is. So now, recommended websites for you to know this news event, this important news event, and how to trade them. We have investing.com, www.investing.com. But let me just go to that website so I will show you what it is all about. So usually the market is very volatile during this news event. So due to this volatility, that means the market moves spontaneously. It moves up and down. It moves in an unpredictable manner during news event. So during this news event, you are not supposed to be trading. You understand? You are not supposed to be trading. You are not supposed to be trading. You understand? Because it will cause you problem. It moves in an unpredictable manner. It can go and hit your stop loss. It can move up and down without you being able to know where to actually go. So you only trade. It's advisable to trade 1 minute before or 1 minute after this news event. Not because we are trying to trade a news event. You are basically gambling because nobody knows the direction the market is going to go. Just like you cannot know what is in the mind of another person. Nobody knows
Mm.
how traders are going to react to this fundamental. The fundamental may come out positive today, but traders may react negative to that fundamental. That's the general market. I don't know if you understand.
Yeah.
So because you don't know, what you'll be doing will be gambling if you want to predetermine that, if you want to trade all this news event. So let me show you how we can use investing.com and make trading decisions if you want to be a core fundamentalist. All right, that's people that make decisions based on only fundamental. But what we are going to teach you in World Bank, it's not just how to make decisions based on only the fundamental, but how to combine the two. That's how to make decision by what you can see on the chart. That's what is called technical analysis. All right, and then looking at the fundamentals, just bearing in mind that we have the fundamentals to support. That's to add what is called confluence, double confirmation to your whole trading. So let me just quickly go to investing.com. Let me show you what it is all about. So let's go to investing.com. Okay, so that's investing.com. Now I want to show you the um, the economic calendar. That's the calendar where this news event are scheduled. All right. So now we'll come to this news, and then we'll come to economic calendar. All right. When we click on economic calendar, it's going to show us the scheduled news. All right. So now I'll scroll down. These are all the news that are scheduled. These are all the news that are scheduled. Now there are different. Let us go to filter. When you click on filter, these are if you want to see news pertaining to all of these countries, you would just click the countries that you're interested in. Let's say we have the Canadian dollars among the currencies that we trade. So we'll click on that and all of that. So based on what I'm going to show you, or you just leave it the way it is. Now, what is most important is that you set there's the kind of news you want to be receiving. You want to be receiving very when you see three bulls, very volatile news that I will have some kind of crazy moves. Three bulls, news that will have only a let's say medium, two bulls, News that will have no influence, one bull. All right. So you apply. So you are going to see news that has that previously have the potential of moving the market periodically in a medium way. That's when we have two bulls. But the ones that, as in the past, have shown to move the market at a very fast rate is the one that we have three bulls. Okay. So what I just do when I come here is to check what the news are telling us and try to avoid trading by 11:35. Alright, that's the time that the market will move in an unpredictable manner due to traders reacting to this news. Maybe this news was bad, like this thing you see red, it means the news were bad. This one you see black, it means it was medium. The one you see green, it means it was good. Take this is very very important. The one you see red, bad news. You see black, it's a medium. Then the green is good news.
Sorry.
So
What's the black?
the black is medium. The red is
Okay, that's the red is a 20% average.
no.
Oh,
What we are talking about is fundamentals.
okay, the fundamentals.
Yes, it's
So
fundamental.
what's the red now? Like on the chart, how do you take to know the red?
We are not talking about the chart yet. Yeah, all we are just talking about it. We are just talking about how you can determine where price is going to go using this
Okay,
all
okay.
this indication.
Okay, I understand now. I get your point.
Yeah, so this is the fundamentals.
Okay.
Yeah, these are scheduled news
Okay.
that are supposed to happen. So now let's say this is the news for the GBP now, for example. For let me go back to the news that have happened. Let me show you how that news affected the market. Now let's say we have this news on the CHF, all right, the CHF, and the news was a negative news. The traders can react positively to this news even though it's a negative news. That's why I tell people that it's not good to trade news because nobody knows the direction the news is going to push the market to. And that's why I also said when I was talking about what moves the market that it's not the fundamentals that move the market, rather it is traders sentiments to that fundamental and other factors. So they can decide to, even though this is a bad news, which would mean that this currency pair, this currency is going to weaken. You understand? Which would that mean that this currency pair is going to go down. When I say something is weak, it's going to be going down in forex. When I say something is strengthening, it's going to be going up. Which means that CHF is going to be going down. But you can see that sometimes CHF will go up, even though we have this bad news. I don't know if you understand. So there are sometimes that we have this positive news, and then the traders may decide not to follow this positive news and still take the market down. Because whenever there's a positive news, what is expected is that the market should go up. But traders can do anything. So sometimes this work, it's a very very good thing to know, to have knowledge about this. It works sometimes, but not every time. Alright. So there are sometimes that this news may come out positive and the market doesn't move positive. And sometimes it may come out negative and the market move positive. There are sometimes that it will come out positive and the market move positive. And sometimes it will come out negative, the market move negative. So that's what it is. So this is how you can know. So when you see this black, it means it is neutral. When you see this red, it means it is bad. It's a bad news. That's when the actual is released. First of all, what you'll be seeing is only previous and forecast. Then when the news has been determined, when 8:30 reaches, this one will now the actual will now be released, and that actual will now tell you what the information is all about. I don't know if you understand. Like now, retail sales is going to tell you that they were expecting the previous was minus 0.8. They were expecting plus 0.6. I don't know if you understand, which is supposed to be positive. But now they got a worse figure, which was minus 1.7, which is worse than this one. I don't know if you understand. So that's what it is. So I don't want to confuse you. I don't want you to understand what that is. Alright. So if now, for example, we have let me look at the GBP. Let me look at something. Okay, we have the USD now, for example. You understand? We have the USD, which means that the USD is supposed to strengthen, right? Now, let's go to our chart. Let's go to our chart. Let me show you something. If they say USD is going to strengthen, and that news came out yesterday, maybe somewhere around here. This was yesterday. The USD is going to strengthen because this is the USD JPY, right? But you see, in this scenario, the USD did not strengthen. That's why I'm telling you that it's just a form of confirmation. Maybe your strategy tells you that USD is going to buy, and that news event tells you that USD is going to buy. That's confluence. That's double confirmation. Then you can buy. It's a high probability trade because you are taking information from the fundamentals and also the technicals. So that is what it is. Let me just quickly go back to. Let me just quickly go back to what we were looking at. So let's. That's what fundamental is all about. Let's quickly talk about most important forex terminology. All right, this is what makes you a forex trader. This is our own kind of technical terms. All right, when the doctor says surgical or cesarean operation, doctors will understand what that means. Now, if I tell you what is a PIP, you may not understand because you have not yet been introduced into what forex is and how we speak our own technical terms. All right, so let me just introduce you to that. A PIP is a measure of price movement in a particular direction. Just like if we want to measure the distance covered by a car, what we are going to do is that we are going to measure it in terms of how long the road is, right?
Mm.
Or if we want to measure the size of a particular shirt, that's the length of a particular shirt, what do we use? We use a measuring tape. So now in forex, if you want to measure the extent price has moved or price is going to move, all right, which that's the extent at which price you are expecting price to move, it is being measured in pips. All right, let me just quickly show you what that is. Let me quickly show you what that is. Now, because this is the app we are going to be using. I'll show you how to open this app and all of that. Now, this is our measuring tool. It's our pip calculator. Now, this is my. Can you see my the cross? It's anywhere in the chart, and I click from there and take it down. All right. Are you seeing this figure? This figure here is telling you the pip. It's telling you that this is 140, 140, 151 pip. All right. So it's our unit of measurement. You see, it's like a ruler. If I want to know how many pip from up here to down here, it is this tool that I'm going to use to determine that. I say, okay, from up here to here, it's about 180 people. I can tell somebody that from up here to here is 180 people because I've been able to measure. All right, that's what a pip, a pip calculator does. All right. So now, what is a lot size? This is your desired risk or reward allocated on a particular position. All right, based on what is your acceptable and most importantly your account size.
Mm.
All right. So now, what that means is that when they say a lot size, this is the risk that you want to take, which would eventually be the reward you are going to get if the market is moving in your direction. This is that thing this is that position size. That means if I want to enter a position, because I told you risk management, you don't have to enter with all of your balance. You have to enter with a portion of your balance, and you want to calculate that portion of your balance. You are going to use a lot size to determine that portion with based on pips. All right. What I mean by that is that if the market moves 2 pips and we are using a lot size of $2 per pip, what that means is that you have been able to gain or lose plus $4 or minus $4 from your account. I don't know if you understand. So now, if we have a total account of $100, for example, and then we have a stop loss of, let's say, I will explain what stop loss is, okay? But I'm just giving you an example. We have a stop loss of 3 pips, and then we have a take profit of 6 pips. All right. Now, if the market goes negative of 3 pips, and your lot size was 0.01, which in forex means 10 cents. That means 0.101, which is 10 cents. That's 10 cents times 3. That will be around 30 cents. All right, that's what you have lost if the thing hits your stop loss. All right, but if it hits your take profit, that will be 0.1. That's 10 cents times 60. Because I said you are risking 3. Your stop loss distance is 3, and then your take profit distance is 4. Sorry, 6. So that's what it is. So lot size is that risk or reward. As we go further, you're going to understand better. Is that risk or reward that you have been able to allocate to a particular trade based on your account size. All right. If your account size is $100, you cannot be using the risks, even though you have the ability to do that. But you are not. It's not advisable to use the risks you're supposed to use $100,000 account or on a $1,000 account, because those accounts can accommodate some level of drawdowns that this your $100 may not be able to accommodate if you use a big lot size. All right. You cannot be risking $10 per pip. It's not reasonable to be risking $10 per pip on a $100 account, because that would mean that 10 pips will blow your account, and the market can move 10 pips within the twinkle of an eye. All right. So it's not advisable. Rather, I will show you how you can determine the lot size to use for a particular trade based on the pip. All right, based on the pip. Now let's talk about equity. The equity shows the actual balance in your account during and after a trade. The equity now, for example, if you have a trade running, let me just quickly give you an example of that. Okay, now let me place a trade. New order. I want to use the list lot size because I'm just placing this trade randomly. Right now, and this is a real account. This is a real account. It's a real account. Okay. Now see, I just placed a sell trade. Okay. Notice my balance is telling me the um, the actual money that was in my account before I placed this trade. Okay. Telling me the actual money that was in my account before I placed this trade. Now my equity is telling me the money that it's minusing from my account. Like see now, we have minus 0.34. It's minusing from my account while the trade is on. That's why I said that the equity shows the actual balance in your account during and after the trade. Okay, during and after the trade. Now see, let's look at that our trade again. Now look at our trade. It's running on a loss, but our balance is still the same. Oh, telling you that this is the what you had in your account before you took this trade. But the equity is showing you the actual what is happening now in this trade that is going negative. It's going negative. It's minus 0.34. Don't you understand? That's what it is. So now talking about lot sizes, let me just go back to that lot size. We have three kinds of lot sizes. We have mini, we have macro, and then micro, and then we have macro. Now the lot size you are going to use is according to your account size. All right. We have for $100 account and we have to $1,000 account. The lot sizes you should use is from 0.01 to 0.09. Then if you have a $1,000 account to that's to $10,000 account. All right. The lot size that you should be around 0.1 to 0.9. Now if you have anything above $10,000, you can use macro lot sizes, which is from 1.0 to infinity. You don't even understand. So now what does 0.01 means in forex? It means 10 cents per pip. That means each 1 pip movement is 10 cents that is either adding to your account or is going out of your account. All right. Now let's look at that our trade that we took. This market is moving in pips. All right. Now remember, prior before now it was minus 0.30 or so. Now it is minus 0.40. That means it's going negative for our direction. Alright, it's going negative for our direction. So minus 10 cents because we used a lot size. Look at the lot size that we used. What is our lot size? Yes, our lot size. This is our lot size. It's 0.01. That means 10 cents is going when the market is going against us. When the market is going for us, it will be plus 10 cents, plus 10 cents, plus 10 cents. You understand? That will be adding plus 10 cents. Each pip, each 1 pip, when the market move 1 pip, is plus 10 cents. But now it is going against us, it's minus 10 cents. I don't know if you understand. So that's what it is. So now, that's why it is not good to use a very big lot size on a small account as ours. Alright, on a small account as ours. If we use 0 point, that's the lot size that is supposed to be for a lot size that is supposed to be for a micro. That's for a $1,000 account to $10,000 account. Use it for that my small $100 account. You blow it because as just talking here alone, the market has moved about 2 pips. Just talking while we are speaking, the market has moved about 2 pips, and then that would be like this would have been reading -20. For this small account, our balance is 96. -20 will mean that we will be at 60 or so. I don't even understand, which is very bad for this small account. That means you are not giving yourself enough opportunity so that your edge may play out. What if you have loses? That your trade you are taking now, expecting that you are going to win, you lose it. Don't you understand? You have lost because you risk too much. You are not going to see when your strategy is going to perform well. That's why you have to use your lot size very wisely. You don't have to be greedy. Remember when we were talking about the characteristic of a successful trader, you don't have to be greedy. You have to use the allocated lot size for your allocated account. So you have seen, I've been able to explain what equity is, I've been able to explain what account balance is. So the account balance shows the amount of money in your account before and after a trade. Now, before this trade, our balance was 96. Alright. Now if I close this trade, now I've closed the trade. Now after the trade now, our balance has now changed to 95. You understand? So the balance shows you, it shows you that's your account balance. It shows you the amount of money in your trading account before and after a trade. Right? Before I placed that trade, it was 96. The equity was the one showing me the actual balance in your account during the trade. Alright? But now, after I closed my trade, the balance now changed to what the equity was showing prior before I closed the trade. That's how it works. So now, what are brokers? The broker are the middlemen. They help you carry out the buying and the selling that we tend to take in the forex market. Because many people will be like, "Are you seeing this money?" The answer is no. We are not seeing this money. When you upload your trading your money in the forex in your broker, you don't get to see the money. So how do you now buy and sell this financial asset that we are talking about at the speed of light? Because of the broker. The brokers serve as the middleman. They are there to ask to receive your orders and then execute the orders for you. So you give your order by placing a trade. I'll show you how to place all these orders in the forex market. Alright. When you place this order, your broker is the middleman. It's supposed to connect you to the market. It's supposed to be that person that if you are winning, they'll be the one to give you the money that you want. If you are losing, they'll be the one to give you the money that you lose. Alright, so they are the middlemen. So now what is leverage? Using broker can actually give you a loan to trade in the forex market. Alright, that's to increase all accounts.
Okay.
So using a broker's account, that's to using broker's money to increase possession power of your account. It can be a good thing, it can be a bad thing. Because it can be a good thing in the sense that it will enable you to trade on some higher losses. That means you can have $100 account because you have a good leverage of 1:1000. You can trade with a micro loss size. You can even trade with a macro loss size under your small $100. But that can be detrimental. Even with the fact that you can make profit if the market goes in your direction. Right? You can make profit. But what if the market does not go in your direction? You will lose that much. Because if you have the leverage to use 1.0, which is about 1.0, which is about $10 per pip. I don't know if you understand. 1.0, which is about $10 per pip. That means if you are losing to it to be minus $10 per pip for your small $100 account. Alright, but if you are winning for that small account, you're having a big leverage. That's the broker borrowing you money. That's increasing your possession power. Alright, that's what it means. So stop loss. Stop loss. This is an order to the broker to close a certain position with a loss to avoid further loss. Alright, that means if your position is losing, you are telling the broker when it gets to 1.26, abeg close my position, let me accept my loss. Alright, that's what a stop loss does. So now what is a stop loss? Then what is a stop loss range? The stop loss range is the distance the market can go negative of your desired or expected direction. That's a stop loss range. Let's say your stop loss range is in pips. Alright, you can see your stop loss range is 12 pips. You don't want to determine that. If the market goes negative by 12 pips, you are out of the market because it will hit your stop loss. Alright, which is not a bad thing. Because it's not every time the market will be hitting your stop loss. There are sometimes it will go and hit your take profit. So what is take profit? Take profit is this is an order to the broker to close a certain position with profit. That means I'm tired. I don't want no profit. Just give me my profit here. I don't even understand. So it's an order to the broker to close a certain position with profit. That's what take profit is. Don't you understand? So I think this is where we should stop for today so that tomorrow we can continue.